Be honest. Do you know what a 401k is? Do you have one? Are you not sure? If you don't know, then don't worry. This is the video for you. And if you do know, no harm in reviewing the basics. The 401k might be one of the best wealth building tools out there for the everyday person. I know people's eyes can glaze over a bit when they get that 401k form at work, but it's absolutely worth spending a little bit of time on to understand how it works. A little knowledge now can lead to massive wealth and money saved in taxes over the course of your working career. A 401k is a retirement savings plan that is offered through an employer. 401k refers to the section of the tax code, literally section 401, subsection K, that describes how it all works. A 401k plan allows an employee to contribute a portion of his earnings towards funding his retirement and receive special benefits for doing so. Broadly speaking, there are two kinds of 401k plans: traditional and Roth. Each plan has its own unique benefits and restrictions. Traditional 401k plans allow you to contribute pre tax dollars towards funding your retirement. Pre tax dollars are, as the name implies, money you've earned before any taxes. Let's say you earn an annual salary of $52,000 at your job and you get a paycheck every 2 weeks. There are 52 weeks in a year, which means you'll get 26 paychecks in an entire year. So every 2 weeks, you are getting paid $2,000. That's the $52,000 annual salary divided by 26 weeks. But when you look at your bank account every 2 weeks, you most likely aren't going to see a deposit of $2,000. Your deposit is going to be less than that, maybe something like $1,600, primarily because of taxes that are withheld from your paycheck. If you contribute to a traditional 401k, your contribution will be taken out of the 2000, not the 1600. In effect, your contribution is a tax benefit as you're reducing the amount of income that is subject to taxes. So if you contribute $500 per paycheck towards a traditional 401k plan, only $1,500 per paycheck is subject to tax withholding rather than the full 2000. The trade off of traditional 401k plans is that while you get tax savings on the front end, i.e., when you make contributions, you will get taxed on the back end when you actually withdraw money from your account during retirement. In all 401k plans, the earliest possible retirement age is 59 and a half years old, and there is a 10% penalty for early withdrawal. Under a traditional 401k, any amount you withdraw in retirement is then subject to taxation. Roth 401k plans allow you to contribute post tax dollars towards funding your retirement. Post tax simply means you contribute money you contribute money that's been deposited in your bank account from a paycheck, i.e., it's already been subject to tax withholding. It'd be no different than if you went out to buy a hot dog from Costco. Both contributions to a 401 Roth 401k and purchases of hot dogs from Costco involve using post-tax dollars. The trade-off with the Roth 401k plan is the inverse of the traditional 401k plan. With the Roth 401k, you contribute post-tax dollars on the front end, but then on the back end, you are allowed to withdraw money during retirement tax-free. So which plan is better, traditional or Roth? Let's save that for the end, as there's still a bit more to get into with what a 401k plan actually entails. Legally, all sorts of investments are permitted to be invested in through a 401k, but the vast majority of investments offered by employers through 401k plans are stock mutual funds. One common misconception about 401k plans is that they are an investment in and of themselves. They are not. If someone asks you what you're invested in, it wouldn't make sense to say, I'm invested in a 401k with no additional info. Think of a 401k plan as a vehicle. as in a vehicle that is taking you to where you want to go, i.e., retirement. So if you have a 401k plan, you could say, I'm invested in a mutual fund through my 401k. When you start a new job, and assuming your employer offers a 401k plan, you'll likely get a form within your first week of employment asking if you want to sign up. The form will likely ask you two main things. One, what percentage of your salary you'd like to contribute, and two, what stock mutual fund you'd like to invest in. Let's discuss each of these items in detail. The decision of what percentage of your income to contribute to your 401k is a big one. Don't brush it off. The maximum amount you can contribute changes every year. For 2026, the maximum annual contribution is $24,500. This $24,500 is the maximum amount for both traditional and Roth combined, meaning you have a maximum of $24,500 that you can spread between traditional and Roth plans. The minimum amount you could contribute is technically zero, but my advice is to contribute at least enough to earn the company match if available. What is the company match? In many 401k plans, the employer will offer a matching contribution to your contribution. In other words, the employer will contribute to your personal 401k plan if you make a contribution yourself. For example, a company may match any contributions you make up to 5% of your annual salary. This means that if you contribute 5% of your salary towards your 401k plan, the company will make an equal contribution and essentially double the amount of contributions that are going into your personal 401k plan. There is no such thing as a free lunch, as the company offers this matching program as part of its compensation to you for your time and labor. But this is as close to free money as you're ever going to get. At a bare minimum, if your company offers 401k plans and offers to match contributions, you should contribute enough to your plan to at least get the full company match. Once you've contributed enough to get the company match for your 401k, should you contribute more? Should you contribute the maximum? This is where the personal and personal finance comes into play. If you've got bills to pay, if you don't have an emergency fund, if you have a bunch of loans that you're trying to pay back, then you're probably better off not contributing more. But if you can swing it, I would try to maximize your contributions, especially when you're just starting your working career or you're just starting to build up your 401k balance. The earlier you start investing, the longer amount of time your contributions will be subject to the magic of compound interest. If you have discretionary income that is currently being used for DoorDash, concerts, travel, and things of that nature, I'd strongly reconsider reallocating at least some of that income towards your 401k. Your future self will thank you. All right. So, after choosing a percentage of your salary to contribute, the next biggest item to answer on the 401k form is what to actually invest your money in. Typically, employers offer their 401k plans through an investment company like Charles Schwab, Vanguard, John Hancock, etc. You'll be at the mercy of whatever stock mutual fund options that investment company happens to offer. In general, I would pick a broad stock market index fund that approximates the entire US stock market or at least the S&P 500. As I've discussed on the channel, historically the US stock market has returned a 7% annual return, and that's inflation adjusted and with dividends reinvested. These broad index funds should also have the lowest management fees. Pick the best broad stock market index available to you, and then you're all good. Set it and forget it. Lastly, let's discuss which 401k plan is better, traditional or Roth. The answer, as you can probably guess, is it depends. Mathematically, assuming your marginal tax rate remains the same for your entire working career, you'll end up with the same amount at retirement for both traditional and Roth. Assuming that tax rates will stay the same can be quite a leap, however. Projecting how Congress and your state legislature will alter the tax code over the next several decades is certainly above my level of expertise. But even casting that aside, it's important to remember that your marginal tax rate is dependent on how much income you earn during the year. People generally are going to be in higher and higher tax brackets as they progress in their careers and earn more money. But once you hit 59 and a half years old, and assuming you are truly retired at that point, i.e., no longer working and earning an active income, your income is only going to be your 401k withdrawal. So, what I'm really trying to get at is that it's complicated. If I had to give a general recommendation, I recommend contributing more to a traditional 401k. You get tax benefits in the current year because contributions reduce your amount of taxable income. Your tax free contribution then gets to compound for decades. And then when retirement finally comes, you can figure out the most tax efficient way to withdraw money from your plan. All right, hopefully that didn't get too technical. I'll just add one general caveat that there's much more about 401k plans that I didn't cover today. There are things like income limitations and other really special rules and more advanced strategies for withdrawing money before retirement age. But the most important takeaway is to recognize that the 401k is probably the most important wealth building tool available to the everyday person. Most people work for a salary at a company. They don't have the ability to depreciate real estate or deduct charitable contributions or write off business expenses and so on and so forth. 401k plans offer certain benefits that aren't really available anywhere else. So don't ignore that 401k sign up form at your company. If you have questions about it, don't hesitate to reach out to your human resources department. That's why they're there. Contribute an amount you're comfortable with and then be consistent with your contributions. Remember, you're making these contributions for your retirement. It can be tempting to just ignore it all, as it can seem pointless to take an action today that won't pay off for decades. Resist this temptation. As Jerry Seinfeld once said, self control is empathy for your future self. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.